All right, let's get right into it. Today, we're talking about a really powerful way to understand the markets. It's called fundamental analysis. If you've ever found yourself staring at a chart and wondering what actually makes a currency's price shoot up or tank, well, you are in exactly the right place. So, let's start with that big question, right? What is the engine behind these movements? Is it just a bunch of random, squiggly lines on a screen? Not at all. The real answer is found when you zoom out and look at the bigger picture. All the real-world stuff that shapes our economies. You see, when it comes to trying to figure out the markets, traders usually fall into two main camps. Think of it like two totally different philosophies for trying to guess where prices are going to go next. Understanding both is, well, pretty key. On one side, you've got technical analysis. These are the chart gazers, right? They're digging through historical price data, looking for patterns and trends. But then on the other side, you've got fundamental analysis. And this is a whole different ballgame. This is about digging into economic reports, news headlines, and even political events to figure out the real forces that are pushing the market around. So what exactly is this fundamental analysis? I know it sounds kind of complex, a little intimidating maybe, but I promise you, when you boil it all down, it's based on one of the very first things you'd learn in any Econ 101 class. So the official textbook definition goes something like this. It's a way of looking at the market by keeping an eye on all the big picture stuff, the economic, social, and political forces that can move currency prices. It's kind of like giving a country's economy a full-on health checkup. But honestly, if you strip away all the jargon from those reports and headlines, you're left with just one super simple idea: supply and demand. That's it. That's the whole game. If more people want to buy a currency than sell it, the value goes up. If more people are selling than buying, the value goes down. It really is that straightforward. So the real trick is figuring out why the demand for a currency might change. And there's a really clear logical connection here. A chain of events that links a country's economic health directly to how strong its currency is. Let's just walk through this chain step by step. Okay, so first, a country's economy starts looking really good. What happens next? Well, that good news attracts foreign businesses and investors. They want in on the action. But to invest there, they first have to buy that country's currency. All that buying creates a surge in demand. And, like we just said, when demand goes up, so does the currency's value. And this slide just nails the whole concept perfectly. I mean, you can see the main idea right here. A good, healthy economy usually means a higher currency value. A weak economy, a lower currency value. It's this direct relationship. As the source material so brilliantly puts it, when a country's economy is rockin', investors pile in, and the currency gets stronger. When it, sucks, well, the exact opposite happens. Okay, theory is one thing, but let's make this real. We're going to use the US dollar in a quick real-world scenario to see how all these pieces actually fit together out there in the market. So let's just imagine for a second. News starts coming out that the US economy is really gaining strength. Maybe job numbers are great, companies are reporting big profits, things are generally looking up. Okay, so what happens next? The country's central bank, which is the Federal Reserve in the US, they see all this amazing growth and they start to think, whoa, okay, we don't want the economy to overheat and cause crazy inflation. So, to cool things down just a bit, they start talking about raising interest rates. Now, why is that a big deal? Well, because higher interest rates mean that financial assets that are priced in US dollars, things like government bonds, are now going to pay out a better return. And that makes them look a whole lot more attractive to investors all over the globe. And here it is, the final piece of the puzzle. For those investors around the world to buy those really attractive, high-return U.S. assets, what do they need to get first? They need U.S. dollars. And that flood of buying creates a huge spike in demand for the dollar, which, you guessed it, drives its value up. See how it's all one big chain reaction? But here is an absolutely critical point you have to remember. Currencies always trade in pairs. The US dollar doesn't just get stronger in a vacuum. It gets stronger relative to another currency that maybe has lower interest rates or a weaker economy. It's always a comparison one against the other. So, if you're going to use fundamental analysis, what are you actually looking for? What kind of news and data should you be paying attention to? Let's quickly run through the basic toolkit for any fundamental trader. And let me just say, don't let any of the fancy words intimidate you. You'll hear terms like macroeconomics, but seriously, like our source material says, you don't need a college degree to get this.
It's just about connecting the dots. So traders are watching these key economic reports. Things like GDP, which is just a big picture report card of the whole economy. You've got inflation rates, which tell you how fast prices are rising. Employment numbers are huge because more people working means more people spending. And then you've got things like consumer confidence and retail sales, which give you a pulse on how regular people are feeling and what they're doing with their money. Every single one of these reports is like a lyric in a country's economic song, and together they tell you the story of its financial health. And that really brings us to our final thought here. When you're looking at a country's economy, is it more like you're reading a report card on how it's done in the past? Or is it more like you're gazing into a crystal ball to predict the future? The real art of fundamental analysis is realizing that it's a little bit of both. You're using the data from today to make your most educated guess about tomorrow.